and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture of my journey and development towards financial freedom and financial independence, and we'll cover topics such as my stocks and shares ISA, my self-invested personal plan, financial products and financial well-being, so hopefully you can reach your aims and objectives towards reaching your financial goals. Remember, if you like the videos, smash the like button, subscribe to this channel so you can reach a wider audience. Now let's get into this latest video. This latest video is about my self-invested personal pension, which I run myself. Now I do have a workplace scheme, but we're limited on the funds available. So the reason is we have a self-invested pension plan, so I control my own investments. Now, the aim of the portfolio is to make an annual return of 10%. For this year, we're looking for dividends of £3,000 and a year-end value of £90,000. If we look at the following chart, at the end of August, we were at a value of £93,228, a year-to-date profit of 28.9%. And if we look at September, our latest valuation, monthly valuation of £94,960, a very nice profit for the year to date of 30.47%, and during the month portfolio increased by £1,732. So very happy with the performance so far for the year to date. Markets enjoying somewhat of a bull run, may not continue moving forwards, but very happy with how the portfolio is performing. Now for the month we made a normal contribution of £100. The government topped up with tax relief. And if we look at the following chart, we've got some very nice dividends of £405.31 during the month. Our average yield of our shareholdings is 2.59%, and dividends received for the year to date £2,674. If you look at the following chart, just a quick overview of where we received our dividends from. So Penn and the Water Company gave us £19.91. Lloyds Bank gave us £209.76, which we reinvested and bought 472 new shares. Barclays Bank gave us £55.94, which again we reinvested 30 new shares. Royal Dutch Shell gave us £26.07. Legal and General gave us £21.70. BP, the oil producer, gave us £19.76. And HPOS gave a nice dividend of £47.92. So well on way to our target of reaching annual dividends of £3,000 for this calendar year. Now, if we look at the portfolio, we were charged by our provider a monthly fee of £14.15. Predominantly 85% is based in the UK and Europe, 12% is based in Americas, and 2% is based in Asia. And if we look at the following chart, a quick analysis of where our holdings are held. So financial services makes up for the bulk of our portfolio, currently 46%. Consumer defensive 17%, consumer cyclical 9%, utilities 7%, and technology is 6%. Just going to dive into where our holdings are held within the portfolio. So to cover our shares first, at the moment we own 17 individual shares, all based in the UK. 8 are in profit, 9 in loss, and our shareholdings make up 79% of our portfolio, of which 64% is in the FTSE 100 and 15% is in the FTSE 250. Our total shares are worth £75,244. A quick look at the following chart. Our major shareholdings. Our largest shareholding is Aviva, nearly 17%. 3,993 shares, makes up nearly £16,000. It was bought as a long-term hold, giving a very good yield, and in the recent months has been on some kind of share buyback, and because of activist investment it will recover, or it will return substantial funds to shareholders. Our next shareholding is Lloyds Bank, We own 31,780 shares. £14,500 makes up 15% of our portfolio. Hopefully a great recovery play at the moment, a yield of about 2%, but moving forwards will give us some great dividends which we'll reinvest within the company. Our next shareholding is Greggs, 266 shares, £7,800, 8% of our portfolio, but up 100% since we bought it. Had some great results recently. Hopefully, dividends will be increased, but a very good long-term company, and hopefully it's expanding, will increase its presence away from the high streets to retailers, out of town sales in shopping centres, garage forecourts, etc. Our next holding is Draxler Power Plant, 1,156 shares, £5,700, 6% of our portfolio. Our next holding is Barclays Banks, 2,827 shares, £5,300, 5.6% of our portfolio. Just like Lloyd's, great sentiment towards banks. Hopefully dividends will be increased, but a long-term holding. Our next holding is JD Sports, 500 shares, £5,200, makes up 5% of our portfolio, but again, just like Greggs, up 100% since we bought it. Has got a great presence in the UK, has expanded into Europe and America the last few months, but a very cash-rich company. It does pay a small dividend, but all the profits will be invested back into the business. And then right down to our smallest shareholding, Card Factory, 1,329 shares, £713, makes up 1% of our portfolio. And during the month we did purchase 38 new shares in HSBC for the cost of £146. It was bought again to diversify from banks, want more of a global bank, but it will give quarterly dividends as part of its restructuring plan in the coming months. So it was bought for cash rich to reinvest back within the portfolio. With regard to some of our shareholdings, just some items of news that have happened in the last month. We own some shares in AG Bar, the drinks retailer. They had very good results, and part of the results, they did reinstate a dividend. They pay a dividend at the end of October of 2p a share, but they were also paying a special dividend of 10p a share. Revenues was up 20%. Profits was 25 million v 5.1 million. Margins were increased, and they're now net cash. So the cash has now gone from 30 million to 65 million. So it was affected during the COVID. Obviously pub sectors, retail sectors severely hampered, but very good set of results, and the dividends are being restricted. So hopefully some growth returning to that business, and sentiment also. Another company gave results was Card Factory. Revenues was up 18%. Pre-tax profits went from 7 million to 24 million, but the most important thing was it done its restructuring of debt. Debt was 144 million at the start of the year. At the interim results, it was down to 96 million. So great progress has been made, one, to restructure the debt, but also to reduce the debt. Now at the moment it's got some bank loans from the government in place. It cannot pay dividends for the next 2 years, but hopefully it will be a great recovery play when the market opens again, and it is a very cash rich business. And another company with very good results was JD Sports. Margins were increased, revenue was increased, and the pre-tax profit went from 41 million to 364 million in the half year, and they reckon for full year results pre-tax profits over 750 million, but it has bought 21 new stores in Europe, 10 in Asia Pacific, and 66 in USA. So it is on a very good expansion plan at the moment. Again, a very cash rich company, does pay a very small dividend, but a very good growth company, and as we said, over 100% profit in that company since we bought it. And finally, items of note is Morrison's. The takeover was finally agreed through the auction process, an agreed price of 287p a share, so it will give us around about £3,300 to reinvest within other companies in our portfolio if shareholders agree later on this month for the next actions moving towards that settlement. So a long running saga, but it will allow us to reinvest some money from one company into other companies for a greater return on investments and also give us some greater dividends. So just a quick recap of the shares we hold. And finally, just a quick overview of the funds we hold within the portfolio. At the moment, we own 6 funds, all in profit, 21% of our portfolio, fund value of £19,455. Now, a quick overview of the holdings we hold. Our largest shareholding is a legal and general technology fund, £4,750, 5% of our portfolio, but a very nice profit to date of 59%. Our next holding is Bally Gifford Positive Change, £3,900, a very select portfolio, owns about 25 to 30 shares, but good quality companies, 4% of our portfolio, a very nice return to date of 44%. Our next holding is a US smaller companies. It was bought for greater growth away from the FANGs and the tech stocks, £3,600, 4% of our portfolio, but a very nice return of 35%. Our next fund was a global equity fund. It was bought for diversification because we were solely UK based, £3,400, 3.5% of our portfolio, but a profit of 13%. Our next holding is slightly selective. It's a UK equity fund, £2,600, nearly 3% of our portfolio. Our poorest performer of 5%, but again, a very good track record from the manager in question. Some great individual companies hold, all good companies, good long-term trackers, and hopefully some great recovery plays in the UK. But it was bought solely on the manager's reputation and their track record. And finally, our smallest fund is a UK smaller companies, £1,100, 1% of our portfolio, a very nice return of 10%. Again, it was bought for diversification. Personally, I believe UK smaller companies will grow a lot better than larger caps over the years. So it was bought for diversification, hopefully give us some great returns year on year towards reaching our aims and objectives away from the larger cap stocks we hold. So a quick overview, 6 holdings, all in profit, but all bought for a long-term reason. Some diversification on. We've got no plans of making any more additional funds, but we may in the future concentrate on increasing our existing holdings. So unless the markets change or the managers change or the fundamentals change, I'm prepared to hold them funds for the next 3 to 5 years. So a quick recap, portfolio is doing very well, well above our expectations for the year to date. A profit of 30.47%, which is even more surprising when you think of half of our shares we do hold are actually showing a loss. Remember, if you like the videos, smash the like button, subscribe to this channel so you can reach a wider audience, and we'll see you in the next video.